Hey, what's going on, cash flow hackers? Welcome back to the final video on the Financial Efficiency Masterclass. In this video, we're going to be talking about opportunity cost, understanding opportunity cost, how to control opportunity cost, what to do about it. I'm going to try to keep this as simple as possible, but the bottom line is that there's so many elements to this, right? I'm going to try to keep it quick and clean and understandable. But at the end of the day, the more sophisticated you become, the more sophisticated your finances are going to become. And so I want to make sure I touch on a couple points that are really simple for people who are just maybe rebuilding credit, getting out of debt, and starting to rebuild habits to be able to get action, right? And to be able to get traction towards accomplishing your goals and improving your financial efficiency. And I want to give a couple little examples that will help you understand exactly the results that you can get in your life by just shifting a couple little things, which, you know, I know every single person watching this will stand to benefit in doing so. Whether you're thinking about how you're going to buy your cars differently, or whether you're a business owner and you're thinking about major capital purchases and financing equipment and stuff of that nature. The idea of when we buy any of these things, you know, there's an opportunity cost that goes along with it. And so I want to get into the framework of that and talk about how the cost of capital works in our life. Now, cost of capital, really simply put, is what's the rate of money that we're spending for that cost of capital, i.e. you want to buy a house. Well, the cost of capital on buying a house, a mortgage, getting a mortgage 3-4 years ago was maybe, let's call it 3%, right? So it was a lot cheaper back then. Now you're looking at 6.5%, 7%, right? At the moment of time writing this or filming this video, it might be a little higher or lower than that, depending on when you're watching this, right? But at the end of the day, the cost of capital is everything, right? Like if you can control that, if you could say, I know that in any environment, I'm going to be able to optimize my cost of capital for any major purchase, for any financing of anything significant, then it puts you in the driver's seat to reduce your opportunity cost and to increase opportunity for yourself, right? So I want to get into a couple concepts that I think are really important to cover before I get into all this. And you know, I want to go here for a second and just say, all right, opportunity cost. So opportunity cost is simply saying we are spending interest. So there's an interest expense on everything we buy. Okay? That's the idea. Everything that we buy. There's an interest expense on everything we buy. That is the idea of opportunity cost. So a lot of people are going to say, all right, Chris, that's not fair. I pay cash, right? That's why I pay cash, because I don't want to have an opportunity cost. I don't want to have an interest expense. Well, there's actually an opportunity cost when you pay cash, right? So there is an interest expense. Why? Because if you spend cash, you're no longer earning interest. Let me give you an example. So if you had money sitting in a high yield savings account, let's call it earning 5%, right? And you then said, hey, I want to go buy a car, and that car is going to cost me 2%, but I don't want to pay this 2%. I'm going to go pay cash. Well, you actually had a 3% inefficient decision, right? Because yes, you avoided this 2% expense, but you cost yourself the ability to earn the 5%, and the net of it all is 3%. And it's actually worse than that, because money compounds more than you pay on an amortized loan. But I want you to understand the idea that you finance everything in life. Either you pay interest to a bank, or you lose the ability to earn interest with your own money. When you understand that concept with your own money and opportunity cost, now we're able to start seeing how we can solve this problem. Now, I want to use this example to kind of drive the point home just a little bit more. So what I have down here is, and I'm going to use this color here, we could see here that debtors, what they do is, I'm going to use this as a car. Let's say we have a $50,000 car, okay? $50,000 car, I'm going to use yellow so I can use it for each one. $50,000 car that we want to go buy. The average American home right now, or average American person, buys a new car every 5 years, okay? So every 5 years, you buy a $50,000 car, you pay it back, and boom, you get to zero, you go, you buy another car, you buy another one, and you can see I did 4 years. The average American has 7 car buying cycles. 7 cycles in their life, okay? That's what the average American does. I just got it here just to illustrate it for a four car buying cycle process. See, the idea here is that at 5% interest, you're gonna have about $10,000 in interest expense. So the idea is, well, if I'm gonna have this interest expense of $10,000 to buy a $50,000 car, that's 20% increase on the cost of the car. I don't wanna pay that. I wanna avoid that cost. So I'm gonna go pay cash, okay? But the bottom line is, if I go pay cash for that car, and let's say I'm earning it in a high yield savings account, earning 5%, I lose the ability for that money to earn for me. And I've interrupted the compounding. If we understand this idea of what's called the compound growth curve, well, I've just started hitting momentum. And with $50,000 in cash here, I'm earning $2,500 a year in interest. Now what I'm gonna go do is, to avoid having to pay this $10,000, I'm gonna go spend down the golden goose, and I'm gonna interrupt that interest. Now, the idea is, I'm not gonna try to argue savers are absolutely in better positions than debtors, but they're not as far ahead as they would have you believe, right? What I want you to understand is, at the end, you could see at the end of every car buying cycle, you both end up at zero. And the reason I say this is because, guess what? You spend money for a car, cash, you still got cash flow wise, you're still saving money for the next car. Otherwise, you're just gonna have to go and become a debtor in the next car buying cycle, right? And when we look at it through that lens, from a cash flow perspective, and life is all about cash flow, right? Your car is just a lifestyle decision. Fair enough, right? The car that you decide to drive is a lifestyle decision. I'm not telling you to buy a $50,000 car. I'm not here to try to convince you or tell you based on your values and beliefs what you should or shouldn't buy for a car. You're an adult, you can make your own decision. What I will say is that if you are going to buy your car, understand opportunity cost and understand the most efficient ways to buy said car, okay? And so you can see here that at the end of 4 buying cycles, we've gone through the same place. And if I went through the end of 7, we're gonna be in the same place. We end at 0. We began at 0, we ended at 0. And now you either drive a beater car for the rest of your life, or you have, to either go in debt or keep the cycle going, which if you're retired, there's no guarantee, unless your money has really worked out well for you, that you're gonna be able to do it. So what I do, this is what I would call the wealth creator, and this is how we utilize whole life insurance as creating your own kind of pseudo banking system, utilizing whole life insurance as a foundational asset, because you can borrow against your cash value in your life insurance policy and never interrupt the growth of that policy. So what you're doing is you're instituting saver-like behaviors right here, and you're saving, and then you're leveraging the insurance company's money and collateralizing, using your money in your policy here as collateral to finance that. Now, that money is going to continually be growing inside of your policy. This is what becoming your own bank, so to speak, or infinite banking is all about. Now, I just think that if you're going to do this, you got to be really cautious. You got to be cautious who you listen to, because it's not about positive arbitrage. It's not about a lot of the niche marketing things, kitschy marketing things that people would talk about. It's simply about implementing good financial discipline, good behaviors, and aligning your money with your values and beliefs. And what that looks like here is, if we just go through these car buying cycles, we're gonna go in debt, but when we pay it back, the money that we initially had growing is gonna be worth more than when we started. Rather than paying money to a bank, we're going to be paying money back to the financial institution in the insurance company, but our money is gonna grow the whole time. And I can show you that your money will compound faster and grow more than the amortized debt that you would pay to the insurance company, which would be also simple interest. And so the idea here is, yes, a lot of people would say, why would I pay money to borrow my own money? Why would I pay the insurance company to borrow my own money? Well, the answer is you're not borrowing your own money. So let's say you paid the insurance company 5% on your money. Well, if I could go and earn 5%, and I'm not saying this is what it would be, I'm just trying to keep it really simple, inside of my policy, if I could do that, well, what is the net of it all? At the end of the day, I never want to interrupt compound interest. I've basically taken what would be an opportunity cost, and I haven't eliminated. You're never going to eliminate opportunity costs on a lifestyle decision. It's one of the things I want you to really understand that a lot of people are not totally transparent about. But I do want you to understand that you can mitigate your opportunity cost, and the more we can mitigate it, we can take that and recapture the opportunity cost that we can recapture, and we can create wealth with it. And at the end of the day, I've shown here, and I drew this out before, that through 7 car buying cycles, for somebody that buys a $50,000 car, just in the way that you buy your cars, you can recapture $250,000. Now, I don't know if you know this or not, but the average 65-year-old in the United States right now only has $237,000 saved. That's the in retirement funds, right? So that's the average 65-year-old, okay? So just the way that you buy your cars, shifting your behavior, shifting your process, being willing to, delay gratification on the front end here and save money and set a plan in place and then start doing this all the way through is going to put you in a position where you're going to be better just in that one decision through financial efficiency and controlling opportunity costs than most people are in this nation, right? And which is sad because we're the most prosperous country financially that's ever existed in the history of the world, yet 95% of people are not able to maintain their standard of living when they hit retirement. And to me, that's the real crisis. That's a real pandemic, even though everybody wanted to be distracted by other things. So I would say, really understanding these numbers, really understanding how this works, understanding that you finance everything in your life, whether you pay cash. Paying cash is self-financing because now it's on you. You've interrupted that compounding, and now you got to save money and cash flow going back into it. And if we start thinking about life through the lens of, all right, what does my cash flow look like? How does this decision impact my cash flow from a long-term perspective? And when we go back to what are my goals and objectives? What are my core values? What's my mission for my life? What's my vision for my life? What do I want it all to look like? And I can reverse engineer a plan. I can start thinking through the lens of cash flow and implementing accordingly. And that's what this is all about. So hopefully this made sense. Hopefully this gives you at least enough clarity to take the next steps and have a conversation and figure out what would this look like in your life. I really encourage you, if you haven't yet already, because I understand some people are going to watch these videos and before they go through and do the values and beliefs workbook, they're going to want to know everything that's going on. I really encourage you, set up a clarity call with somebody on the Life 180 team. If not, the person that actually shared this video with you, if you got directly referred to this masterclass by somebody on the team, meet with them. Go through the values and beliefs workbook with them. Fill out the X-ray, the financial X-ray. Go through that process. Get your financial efficiency in order, and you can take control of your financial results in your life. Start thinking about cash flow hacking. Start thinking about investing for cash flow to accomplish the desired result that you have for your life. Don't think about the returns that you're going to get. The returns are going to happen. They're going to be there. You're going to have to go get returns and take risk. You're not going to do that inside of the policy. You're going to do that in real estate, in business, in some other avenue in life, some other investment strategy. But you can't run before you walk. You got to walk first. You got to build the financial foundation in your life. It's about financial structure. You got to be willing to go slow to go fast, and that's what we're talking about. That's what this whole strategy is about. And if you can implement a little bit of discipline and understand that, you can accomplish what you want to accomplish way faster than you could ever imagine. So if you have any questions, reach out, and we're happy to help. We've got a team of support, and I know that the person that you connect with is going to be able to help you. So that's it for the masterclass. Go down in the link in the description below. Make sure you click the link, set up a clarity call, answer the questionnaire, go from there, and we look forward to serving you. Have a blessed, inspirational day. We'll talk soon.